Yo, what's up you guys? Welcome back to another video. Today I'm gonna show you how to flip 100 into 1,000. No, I'm just joking. I'm not here to waste your time. What I do want to talk about is how you can do a fundamental analysis and how you can apply it. Now this is the first part of a 4-part video that I'm going to do. The first one we are going to focus on fundamental. The second one we're going to focus on order flow. The third one is going to be technical, and the last one is going to be retail sentiment. So without any further ado, let's jump straight into it. So let's talk about what is fundamental information. So to give you guys a simple understanding. So the idea is basically to show you guys exactly how I use the fundamental data, but also there is a list of videos that I have done. You can go check out on the channel. Fundamental analysis, how to apply fundamental to technical and all of that stuff. What I'm about to show you now is the most simplified version of the way I currently look at it, so that you can easily just go there and apply it. Now the sources I do use for these news events is basically Forex Factory and then obviously CNBC to go and look at the news. So fundamental data is basically news events that we take a look at. Remember, in order to determine the strength of a country's economy, we need to look at in order to determine the strength of a country's currency, we always look at the economy. Now the economy is driven by certain factors, news event factors, right? And these factors include a overall jobs report, interest rates, inflation, the GDP, and all of these things. So think of it yourself as being a consumer, right? Not a consumer, an investor. If you are an investor and you wanted to invest into a country's currency, you obviously wanted to make sure that you will get high returns, and you want to make sure that you invest in the country that is doing well in terms of their economy. So we use fundamental data to make better trading decisions when it comes to technicals, but we're going to get to that. This is, like I said, the first part of a 4-part video series that I am going to do: fundamental, order flow, retail sentiment, and technicals. One video will be dropped every week. Now, the first thing that I obviously do is there's 4 news event factors that I look at. The first one that I do look at is CPI, and then the next one that I do look at also is the NFP, and then the next one that I look at is let's go clone, we go rate decision, and this is basically interest rate decisions. And then the last thing that we are going to speak about is Powell speech. So Jerome Powell, I'm sure a lot of you know who Jerome Powell is. So these are the 4 things that I look at when I want to make better trading decisions in the market. Now we're going to talk about 2 things. We're going to talk about the dollar index, and we're going to talk about the NASDAQ. Now you can use these 2 key indicators to basically trade anything as well. So we're going to use the NASDAQ and the dollar index. Now, why do I look at the CPI and rate decisions and the NFP and Powell speech? Because the 3 of these has got a direct correlation with one another. The one determines where the other one's going. Now, in here, we can also go, basically, we can also say the 10-year. So I'm going to put here the 10-year as well. So you guys know the 10-year treasury yield. So we're going to put here the 10-year as well. Now, the reason why I look at these things basically is because these things, they work one-on-one with each other. They work so beautifully with each other. And the reason why I say that is because if you understand what the CPI data is, you can basically determine whether the Feds are not going to hike the interest rates or not. And the 10-year normally reacts before that, which gives us an indication as well. Now let's start with the CPI. The CPI is basically an indicator that is used by investors to measure inflation. Now remember, when the CPI comes through higher, that means inflation is higher, and when the CPI number comes through lower, that means inflation is decreasing. Now, what does that mean for the 10 yield? Now, if you get a high CPI reading, you can definitely expect 10 years to be high, and that means you can expect, if you get a low CPI reading, you can expect the 10-year to come down. Rate decisions, same thing apply. If the CPI is higher, you can expect the rate decision to be higher. If the CPI comes to lower, you can expect the Feds less likely to hike the interest rates. Now I'm going to show you how this all works. Next, we've got the jobs report. If CPI comes down, you can expect a higher jobs report in the long term than if the CPI comes through negative. You can expect a lower jobs report. Now, Powell is another story. We basically monitor the minutes that he speaks about, because whenever it comes out, he normally speaks about these things, and we use that information to determine whether or not he's going to hike, well, you know, what his plans are for the economy, and we basically focus on what he says about inflation, whether it's too high, whether the Feds need to hike it, whether, you know, it just gives us an indication. Now, remember, when CPI goes up, you can also expect the dollar index to increase in value. If the CPI comes down, you can normally expect the dollar index to decrease in value. Excuse me. Either a decrease in value or it stabilizes. It means that there's not massive movement in the market. Then next up, we've got the NASDAQ. Now, most of you obviously know that the NASDAQ is negatively correlated with the index. So when the CPI comes through higher, you can expect a weaker stock market. And if the CPI comes through lower, you can expect the stock market to go higher. And because there's a negative correlation between what we have here, is we have a negative correlation between the index and the NASDAQ 100. That is why that is what we're going to be speaking about very quickly. So how does the CPI tie into the interest rate decision? Firstly, the CPI is a consumer spending index. This means what consumers spend. So it measures what consumers spend over a period of time. Now, the job of the Federal Reserve is to make sure that they bring down inflation. I'm going to add here inflation just so that you guys can understand, so that you don't get confused, right? Bring down inflation. The output job of the Federal Reserve is to make sure they bring down inflation. Now, when inflation needs to come down, the Fed only has one tool at their disposal. Remember, inflation increases in value when consumers go out there and they spend like crazy. Now, the Fed will normally decrease interest rate. Lowering interest rate will encourage consumers to go out there and spend as much money as they can, right? But in order to bring down that spending index, what does the Fed needs to do? They need to hike interest rates. Interest rate hiking discourages consumers to spend. How does this work? Remember that when interest rates are low, that means you can buy certain things on credit. You can take out loans. You can buy houses at a lower interest rate. So it's buying houses, buying things on credit, all of that stuff, because what you need to pay back will be less. Remember, your salary will probably maintain the same. Now, when the Fed, now imagine you've taken out $10,000 worth of items at a 1% interest rate, right? That means you have to pay back 100 Rand over a period of time. But now things are getting out of hand. Now the Federal Reserve needs to bring down that inflation. So what do they need to do? They have to hike the interest rates. Now, when they hike the interest rates, this will discourage consumers to go out there and spend. Why? Because the interest rates that they have attached to their debt now increases. So opposed of having 1% debt attached to your $10,000, you now maybe have 3% interest rate. That means your debt now increases, your salary stays the same. That means you can't go out there and spend as much money as you can. Now, where do you go and spend this money? This money is all spent on companies that are listed on the NASDAQ. For example, you have companies like Apple, Tesla, Amazon, and these companies make money through consumer spending. So when consumers are discouraged to spend, these companies are basically not generating a revenue. Therefore, you'll normally see the stock market take a collapse. With a higher CPI reading, you can expect a higher interest rates. That means investors are now more likely to invest in the dollar because their return that they will get back on their investment is higher, but consumers will have less money in their pockets, meaning they'll have less money to spend on the stocks, and that's why you see it fall. I hope you guys are still following me, right? Now, the 10-year is also an indicator. Whenever you see the 10-year drop, you can normally expect the Feds to either pause or lower the interest rate hikes. When the 10-year increases, you can normally expect the Feds to hike the interest rates, because that is an indicator, again, used by investors to measure whether or not the Feds are going to hike the interest rates or not. NFP. How does it impact NFP? Now, like I've said before, when the inflation is low, this will encourage consumers to spend because interest rates are low. Now, the more consumers spend, the more money these companies make and the more jobs they can basically get for the people, meaning that you can get very positive jobs reports. However, when the Feds see, oh, inflation is too high, the Feds now have to start hiking interest rates, and with this, consumers are less likely to spend because their debt has increased, and because of this, the dollar index will take a knock-on effect, and because of that, companies like the Nasdaq will then start to make money. Okay, let me just repeat that again because I might have worded wrong. When you see inflation increase in value, you can expect the Feds to hike the interest rates. That means that the dollar index will increase in value because this will encourage investors to invest because they'll get a higher return on their investment. This will get stock markets to drop because it will discourage consumers to invest or to spend. While if inflation comes down, starts to cool down, this means that consumers will have the Feds are less likely to hike the interest rates. Consumers will then have more breathing room. They might bring their interest rates down, but this means consumers will have more breathing room. They will have more money to spend on the companies that are listed on the Nasdaq, and that means you can expect the price of the stock market to increase, and that means you can expect more jobs to be added because companies are making money. But if companies are not making money, they can't recruit new people, right? Now, guys, that is a very simplified way. I hope you guys understand. Like I said before, if you need a more in-depth, I've made 1, 2, 3, 4 videos on this topic. I would encourage you to go there and read that, to watch that. If you are looking to understand what these abbreviations mean, you can use that as well. Now, the next video I'm going to drop next week, it will be on order flow. This is basically what the biggest institutions are doing in the market. So non-commercials, hedge funds, banks and institutions. And I will do another video on that, and it's all for educational purpose. Thank you for your time. And as always, cheers for years.